So you knock doors, you cold call, you cold reach out to people, you close deals all year long, making hundreds of thousands of dollars for your gritty hard work just to get almost half of it taken away by the IRS. And your CPA might set you up with an S Corp, get some basic deductions, and set up a SEP IRA, and you still are paying tons of money in taxes. Think about it, just 20% on $500,000 is a $100,000 tax bill. And after 10 years, that's $1 million that the IRS just stole from you, your future self, and your family. Now, I know there's people out there that think that you need to pay your fair share, but if you're a sales rep, you're a competitive killer and you just want to learn how to save your money. So let's talk about it. In this video, I'm going to break down 5 strategies that your CPA is not telling you about that could save you tens of thousands, if not hundreds of thousands of dollars in taxes this year. And if you guys don't know, my name is Aaron Shablowski. I used to be a door-to-door salesman. I bought my first company at 19 years old. I scaled it to over $400,000, and that's when I sold it when I was almost 21. And now I'm building a tax strategy firm for sales reps like you. I'm not here to file your return and meet with you once a year. I am here to be with you throughout the entire course of the year, do everything for you that I can to make it so that you pay as little taxes as possible. And so the general basis that I want to cover in this video is that you have to understand that the tax code is all a book of incentives that is made to make it so business owners and investors get as many deductions and breaks as possible. But it's up to you and your tax professional to find the ones that actually suit your needs. It is all a game, and it is a game that you are capable of winning. However, it takes a shift in how you operate. It's not as simple as just, I'm gonna claim this deduction, this deduction, this deduction. It is changing the way you see money, changing the way you invest, and changing the way you live to frame your entire life around the tax code to gain access to those tax breaks. So let's jump right in and tackle the basics. Number one is if you are on a W-2 versus a 1099. Now, it is very simple. I recommend to every single sales rep that I talk to that they get on a 1099 as soon as possible. For starters, sales is a competitive industry, and you should be happy to operate on an eat what you kill basis. It might seem enticing to get the health benefits or to get the upfront salary check every 2 weeks, but in reality, that is severely limiting your ability to earn. And more importantly than that, it is inhibiting on your ability to execute tax strategy and investment planning. See, it's a simple fact. W-2 employees don't create jobs for the economy. W-2 employees simply work for a business. And it's not to limit what you do and to say that what you do isn't important, but the point is that the IRS just doesn't see it as valuable. And so when you are a 1099 contractor, you can operate as a business, and the government gives tax breaks to businesses. Even as simple as setting up an S Corp and starting to claim some of those lifestyle deductions, the phone bill, the laptop, the home office, those things are going to give you tax write-offs that are going to work against your tax bill. Now, the caveat here is you are going to have to pay 15% self-employment tax. However, the benefits of switching over to a 1099 contractor are dramatically better. And at the end of the day, if a company is willing to limit your downside and give you the protection, if you don't sell anything that week, you still get paid, okay, they are going to cap your upside. It's simply the nature of business. They might sell it to you as having skin in the game, but in reality, it's gonna come with commission caps, salary caps, and things like that that are gonna limit you from getting to that $500,000, $700,000, $1 million plus income that you dream of. So if you're in this situation, I heavily suggest that you recommend to your employer that you make the switch and that you become on a more of an eat what you kill basis. And then also, if your employer is not willing to do that and you see that you're not making as much money as other sales reps, maybe it's time to make the transition into something that is more of an eat what you kill role. 2, the SEP IRA. So let's say you're a 1099 contractor and you're making a few $100,000 and you go meet with your tax accountant. You might have heard that this tax accountant was a guy that helps door-to-door salespeople or other types of salespeople. So naturally, you trust them. However, in my experience of talking to people who work with these types of accountants, okay, is that they do not know what they are talking about. See, CPAs are very good at filing tax returns and finding basic deductions and making sure everything is done cleanly and pretty, and that's a very important role in your financial life. However, CPAs are not tax strategists like enrolled agents are. And a tax strategist is actually utilizing the tax code to try to make it so your tax bill goes down. And this is one of the huge errors where this happens. See, a CPA might not know the difference between a SEP IRA and a solo 401k. However, it's an extremely important difference. See, the difference between a SEP IRA and a solo 401k is seemingly minuscule. They act very similarly. They both create deductions year one for retirement savings, and they both actually have the same contribution limits, which are going to be about $72,000 in 2026. However, there's a couple foundational differences between the two that make them very different. See, with the SEP IRA, you're very limited in what you can do with that money. However, with a solo 401k, you are allowed to execute what is called the mega backdoor Roth strategy. And this gets a little bit complicated, and I recommend that you work with a professional, but here's the basis of how it works. You set up a 401k, and within that solo 401k, you make your contributions, and at the end of the year, you make an after-tax contribution. So you do not claim the tax deduction on that money that you put into it. However, what you can do is convert that 401k, that money that you put in, into a Roth IRA. And yes, you heard me right. You could be making $500,000 and be putting money into a Roth IRA. And better yet, you're not limited to the $7,000 contribution limit. You can put as much as you want up to that $72,000 number. So you could literally be putting 50, 60 grand into a Roth IRA every year. And now that might not be the best strategy for you because you might need the upfront tax savings, which is why I recommend you do a mixture of both, but you're leaving money on the table by not being able to do this. The fact that you can come out with millions of dollars when you are 59 and a half completely tax-free is a huge advantage. And for me, I'm somebody that's generally against the 401k, but this is an option that is absolutely amazing to capture those tax savings. On top of that, 401ks you can loan against. And there's a huge part of the SEP IRA that if you put money into a SEP IRA and you had money into a Roth IRA, you're going to get taxed on what is called a pro-rata portion of both. And so when you go to make withdrawals when you're 59 and a half or 60, what's going to happen is the IRS is going to calculate, this is how much you put into the SEP, this is how much you put into the Roth, you're going to get taxed on whatever percentage of each. And the problem is that this is going to lead to you essentially getting taxed on some of the money that you put in that was intended to be distributed tax-free. It gets a little bit complicated, but it's very clear when you run the numbers that a 401k is way better than a SEP. And so you hear this and you're like, okay, Aaron, yeah, the 401k is better than the SEP, but why the hell is my CPA setting me up with a SEP then? The reason why is it's literally just easier. It takes like no paperwork. You go online, you fill out a form, and you have a SEP. A 401k, you have to make a contract, you have to file a couple more forms. It's still not the end of the world to set up. I definitely wouldn't recommend you do it alone, but you take the extra step and you get the rewards for it. It's a no-brainer in my decision. I would almost never set up any of my clients with a SEP. It almost never makes any sense. 3, the short-term rental loophole. This could be by far and away the best option on this list. 4 and 5 are really good, but this is one that I'm super passionate about. The short-term rental loophole goes something like this. See, when you invest into real estate, the biggest mistake that people do not realize is they hear about all the great tax benefits of real estate, but they don't realize that almost none of those deductions that you get in your real estate actually go against the money that you made in sales. So you can make $500,000 in sales and invest in $1 million of real estate, and you will get a $0 deduction against your sales income. It's 2 separate buckets. And this obviously sucks, right? We want those deductions to come and work for us. And real estate can still be a great investment. But the IRS allows 2 ways for us to get around this. See, as a tax strategist, I try to say, how can we make those deductions become active against our sales income? And the way to do this is, 1, you can become a real estate professional, which means you work over 750 hours a year on real estate, and it is over half of the amount of work that you do in the year. However, if you're a sales rep, it's not really possible to become a real estate professional. The only way is if you were married to somebody who was. But since I assume that doesn't apply to most of you guys, I want to talk to you about the short-term rental loophole. See, the short-term rental loophole says that if you are running a essentially Airbnb business, you are allowed to take all of the deductions that you would have had in real estate against your active income, because the IRS essentially sees it as you running a business. So what you could do is say buy a $1 million Airbnb, okay, and take the deductions of that year against your active income. Now there's kind of a part 2 of this, okay, which is the fact that if you were to buy a rental property that is residential, you have to split up the cost of that rental property over 27 and a half years. This is where things start to get complicated and why it's so important to work with a tax strategist. Because you can split that cost over 27.5 years, the deductions of real estate actually don't become that great. However, this is why we pair in with something called a cost segregation study. And what a cost segregation study says is that some of the things in the house actually are not the building itself. It might be kitchenware, it might be toilets or things like that that depreciate over a time that is faster than 27.5 years. And so by paying for a cost segregation study to get done, you can end up getting hundreds of thousands of dollars of a tax deduction in year one. With that $1 million property, you could get a $200,000 to $400,000 tax deduction in year one, which means if you only put $200,000 down on that property, you could potentially be netting $100,000 or $150,000 tax loss on your tax bill. And keep in mind, that is money that you literally did not pay for. And this is why all of the rich use debt, as you've heard. Now, with interest rates right now, it can be really hard to find cash flowing properties, and it's very realistic that you are not going to make money on the short-term rental in year one or year two, but the tax losses will actually create such a difference that it won't matter. Now, I recommend you never buy a property that doesn't cash flow. However, with the expectations of interest rates dropping, that will allow you to capture some appreciation when housing prices go up, and it'll allow you to refinance. Obviously, don't put yourself in the red, but if it's on the line, this might be a huge opportunity in the market. There's a bunch of other stuff about this that can make it really complicated. It's not as simple as just buying an Airbnb, but if you work with a tax strategist and implement this correctly, it can be the biggest move that you make. 4, let's say that you don't want to manage an Airbnb, but you still want a massive tax deduction. Well, what you can do is invest your money into an oil and gas well. See, section 469C3 says that you can put money into an oil and gas well and take all of the losses on that investment as an active loss. See, the way that the tax code works is that if you invest in something passively, like we talked about with real estate, you don't get a deduction for the losses on that investment. Meaning that if you go buy an ETF or a mutual fund online, you go buy some Apple stock, because the government knows that you don't actually work for Apple, that stock is counted as passive and you can't claim a deduction. Technically, you get up to $3,000, but that's pretty much peanuts on the scale that we're talking about. So that stock could completely lose its value, or there's other expenses that are going on within Apple that you do not get to claim as tax deductions. But the other problem is you don't have the time to full on start a business. So instead, what you can do is invest in oil and gas, and the government actually gives you the thumbs up to call this an active business. It is literally just a loophole, a strategy that exists to help people invest into oil and gas. Now, it's risky and there's tons of hit and miss stuff that can happen with this, and there are shady dealers out there, so you need to have someone on your team that is vetting the deals that are proven, but it is a huge way to get massive tax deductions. For example, you could put $100,000 into an oil and gas well and get a 60 to 100% tax deduction in year one. And that oil and gas well could be cash flowing for 10, 15, up to 50 years. Not all of them are going to be that way. There is risks involved. However, it is a huge opportunity and it's way less work than an Airbnb. Once again, active deduction, completely against your sales revenue. If you made $500,000 in sales and you put $300,000 in an oil and gas roll, you could get $250,000 in deduction today, which could be $100,000 of tax savings. 5, direct indexing. Now, direct indexing can get a little bit complicated. It is not a strategy that you should ever try implementing on your own. However, it is extremely powerful considering the way you should invest. So you remember earlier when I said I wasn't a big fan of the 401k? The reason why I'm against it is because if you're a sales rep and you're a high earner, likely you want to build a $10, $50, $100 million estate. And you want to have tons and tons of money. And the reality is you're just not going to 401k your way there. There's limits on it, how much it can grow is limited, and the cash isn't liquid. So I am a huge advocate of keeping your money liquid into something called a taxable brokerage account. This is just a basic investment account that you set up through Fidelity, SoFi, anything like that. And the thing is that this account has 0 tax benefits. It doesn't have any tax benefits at all, but the cash is completely liquid and you can do whatever the hell you want with it. So if you want to sell and go buy real estate, you can do that. If you want to sell and go start your business, you can do that. The problem is that we get taxed on this account every single year. All of the dividends, all of the interest, and then if we sell anything at a capital gain, we're gonna get taxed on that income. I'm recommending that we put all this money into this non-tax sheltered vehicle. How do we protect that money? Well, we utilize a strategy called direct indexing, and it works basically like this. Instead of buying an entire meal, We are going to buy the ingredients and make the meal ourselves. Now, the nice thing about this is that you don't have to pay the fee of the chef who would have made the meal, but you're probably going to have to still pay a fee anyways because you probably don't know the ins and outs of this. However, it's totally worth it. So continuing and explaining this, think about it this way. See, when you report to the IRS what happens in this brokerage account, all it sees is if your ETF went up or down that year and if you sold. And let's say you did sell and you made a capital gain on that. You are going to get taxed on the gains of that account. However, as you guys probably know, in an ETF, there might be 500 stocks and you're getting taxed as if you had a gain, yet there might be 100 of those stocks that went down in value. However, you don't get to claim the deduction for those losses that occurred under stocks that you technically had ownership of. So instead of buying the entire index, what you do is you buy each stock individually. You buy 500 stocks and you buy literally like 0.5% of each. And what you do is as you get closer to the end of the year, nowadays there's softwares and financial advisors that will do this for you, is you sell the ones who have gone down in value. And then you go buy different stocks. And so what'll happen is your portfolio will have the same exact net profit as the portfolio that held the underlying index. So if you bought the S&P 500 ETF and you bought the direct index of the S&P 500, your net profits will be the same. However, you will get to take a deduction for all of the stocks in the S&P 500 that lost money that year and you sold. This will create what's known in the finance world as a tax alpha, meaning it's a tax deduction that will benefit you. So now if you had, say, $10,000 of gains, previously, you would have had to pay tax on all $10,000. However, you might have now $10,000 of gains, but say $5,000 of losses. And this saved you $5,000 off of your tax bill. Look guys, at the end of the day, the amount of money you make is a direct reflection of the performance that you had that year. And as a sales rep, I know that you guys are competitive and you guys are looking to make as much money as possible, but you need to protect your backside. And more importantly, I wouldn't recommend you guys try to do this all alone. It's only going to distract you from your ability to go sell more and more. Getting someone like me, a tax strategist, on your team will dramatically be able to help you reduce your tax bill and grow your investment portfolio. You have to keep in mind, if you work with a CPA that has the vision of retiring at 65 with a couple $1,000,000 in the bank and a paid off house, that's where you're going to end up. But last time I checked, you got into sales because you want to drive a Lambo, you want to wear a Rolex, you want to live in La Jolla, Del Mar, Huntington Beach, LA, New York City. You want to live in those places. Well, if that's you and you want to win, you want to earn tons of money, make sure to click that subscribe button below. You can reach out to me and my team and I will personally consult you on how we can reduce your tax bill and grow your investments at the same time. Make sure to like and I'll see you in the next video.